Okay, welcome. We're going to get started in about a minute. Just give maybe an extra 30 seconds to a minute for other people to log on. Young Wong, who normally leads the beginning of these presentations, got called away to solve a tricky tech issue. So we're expecting her back in a few minutes. I'm Kristen Jacks. Usually Young introduces me. I'm the author of Money in Your 20s and also Investing Your Lively Jargon-Free Guide to Getting Started. This is my third season running the investing discussion group. I really enjoy all the things that we dive into, like bonds and asset allocation. And tonight's topic about macro environment is going to be really interesting. So we'll just give it maybe another 30 seconds and then we will get started. Okay, welcome everybody to the investing discussion group. Young Wong, who is the business librarian who normally does the introductions, got called away for a tricky tech issue. We expect her back shortly. She usually introduces me, so I will just introduce myself. I'm Kristen Jacks. I am the author of Money in Your 20s and a book called Investing Your Lively Jargon-Free Guide to Getting Started. My background is that I started at personal finance magazines back when personal finance magazines were all the rage, back when you had Money and Smart Money and Kiplinger's and Mutual Funds magazine. We were having quite a time back when magazines were thriving before the internet was thriving. So I did Kiplinger's Personal Finance for 3 years. I did Mutual Funds magazine for 2 years, and I just got completely hooked on personal finance and managing your own investments. So I love running the investing discussion group, and let's get started. Okay, so tonight's let me get my slides. Okay. Actually, let me just welcome you to season 3 of the investing discussion group and let you know that everything we're doing this year, we meet once a month, is based on feedback from people who've attended these webinars and the things that they are clamoring for, like more information about taxes, tax consequences of investing, how to handle asset allocation. People really love the whole cognitive bias, how we're wired personally to react, whether, our moods, our fears, our enthusiasm, all those things. So we're going to cover all of that. This is, I guess we've already covered a few of them, so I'll explain to you how you can get to those webinars. But tonight, one of the things people had asked about was the economy and really looking at what does it mean, for our investments when the economy is too hot or if the economy is cooling, and how does the economy or sort of these macro trends play into investing? So we're going to cover that tonight. For the things that we've already covered, it's very easy to find these webinars online. So we have the Greenwich Library has its own YouTube channel. So if you go to YouTube and you search Greenwich Library in the search bar, you'll actually see, a bunch of things pop up in every search, but you're looking for that kind of green and white logo that's like an open book with the tree icon inside of it. So that's the Greenwich Library logo. And if you click on that, it takes you to the actual Greenwich Library page. So you'll be able to see, and the library does a ton of programming, so you'll see a lot of videos, but all of these webinars live at the the Greenwich Library YouTube site. And we've had some really wonderful, wonderful webinars this season and past seasons. People loved the psychology of money. They loved what your financial advisor isn't telling you. The Power of Zero is a recent one. That was one of the tax ones that was all about tax-free retirement and whether or not that's even possible. It's been getting a lot of airtime. David McKnight wrote a book called The Power of Zero, where he really talked about if you understand Social Security law and tax law and insurance and all these things, how you can kind of have income in retirement, significant income in retirement, and not pay federal tax. Pretty fascinating, not that easy to do. But in that webinar, I kind of walked you through how you can get close. You can kind of hang out in the 12% federal tax bracket, only pay 12%. That's much more doable than paying 0. But definitely like kind of a puzzle to put it all together, and a really interesting webinar. So again, that all lives on the Greenwich Library YouTube channel. And tonight, tonight we're doing, we called it "It's the Economy, Stupid," just kind of based on that like Bill Clinton line, but which is really just looking at what does it mean for our investments when the economy is getting too hot or too cold, and how do we know, and what macro indicators are we looking at? And then planning ahead in January, we've been asked to look at like the staggering cost of private college approaching, if you have a young kid now, you're going to be paying $400,000 for a 4-year education. So, how do you survive that? What are the strategies for that? And there's a lot of good news there. There's so much going on with affording college that, if you're a relatively new parent, you might not have even heard of some of these things, but there is hope. So that's coming up in January 14th. Okay, and then quick disclaimer, we are taping this right now. Quick disclaimer, this webinar is for educational purposes only. It is not intended to provide investment advice. None of the investments or investment strategies mentioned in this discussion group are recommended or discouraged or anything. We're just educating you. And before you make financial decisions, you're urged to consult a wide range of professionals, a tax expert, a financial advisor, who are aware of your unique needs and situation. And also, please participate. So, we have so many smart people in Greenwich, so many people with experience, or even if you just have a question, you can put the question in the chat, you can unmute and just ask your question. So I'll try to remember to pause at different times to encourage that. But anytime you have a question, you can go ahead and put it in the chat. All right, tonight we're going to have fun with economic indicators because it's the economy, stupid. So what is that all about? What do we mean by that? So if we look at investing in general, when we look at, why do investments, why do stocks rise? Why do stocks fall? Why do bonds rise? Why do bonds fall? What are we looking at? And we've sort of distilled down these 5 areas, really. Like there are the fundamentals, right? So if you're talking about stocks, we're saying, that individual company has good leadership, good earnings, sales are growing. Those are the fundamentals, the things that are intrinsic to an individual investment, that the company is well run, or they're lowering their debt, or they're raising their dividend. These are all things that are inherent to a company and how it's being run, and whether or not its products are valued in society, and whether people are buying, whether they can hold price or raise price. Those are all the fundamentals, right? So obviously when things are going well with a company, you would think that would be reflected in the stock price. So when we look at like how investments are doing, we can say, okay, well, the fundamentals clearly matter, right? Then there are a whole bunch of people that look at technicals. These chartists, these people who sort of obsess over how a stock price is doing and what's the volume, like how many shares are trading, and they truly believe in certain patterns, right? And like one pattern in particular is just momentum, right? So if something's going up and it has a clear pattern of going up, it's hard to explain, but momentum is this phenomenon that people, over and over again, it's shown that momentum is real, that once something has a pattern of going up, it tends to continue to go up, even, regardless of fundamentals, regardless of the economy and things like that. So that would be like a technical factor, but much less important for, what I've seen and our purposes tonight, but worth noting. Then you have macro factors. So that's what we're going to talk about tonight. That's when we're talking about the economy, right? So what's going on with jobs? What's going on with inflation? Is there any evidence of the economy cooling? Is there any chance of a recession, or are we going to have a soft landing? And what factors are we looking at to sort of maybe predict whether we're having, a recession or a soft landing. So those are the macro factors. That's the macro environment. And when you signed up for this webinar, we were talking about how investments exist in a macro environment that can either boost the investment or bruise the investment. So hopefully you found that interesting, and that's why you're here. Then we also have behavioral factors. So this has become incredibly popular. We have so many relatively new Nobel Prize winners that are saying, hey, forget it. Man is not rational. So all this stuff, you can look at the data and the science, you can look at the fundamentals, you can measure everything so carefully, but you're still dealing with humans, and humans are emotional and imperfect, and they overreact, and they do all these behavioral things, and that's really what's moving the investment price. So that's, this school of thought, these behavioral factors have become really popular and definitely worth noting. And then you have other things, right? You just have things like tax loss harvesting, like investments, toward the end of the year might move because if a stock has been going down, it might go down further because people are doing what's called tax loss harvesting. This is just one example of the other things that can happen that move investment prices. So if somebody has an investment and it's been losing money, they might actually want to capture that loss. They might want to sell to capture that loss to offset a gain somewhere else on their taxes. And that's what tax loss harvesting is. So there are all different reasons that investment prices move. And so these are sort of the big five: the fundamentals, technicals, macro, behavioral, and then this kind of other category, right? And we, periodically talk, and we just zoom in on one of these. Like we had a really good webinar all about the behavioral factors. I think it was last June. It was based on the book called Misbehaving by the guy who's considered sort of like the father of behavioral finance. And we'll mention him a little bit later. And, we've certainly covered the fundamentals and earnings and things like that. And, when a stock is profitable or sales growth or things like that. But tonight we're going to zero in on the macro. And if you happen to be interested in, sort of this, like these different factors, I always give away one chapter of my book for free if people are interested. So one of the chapters is, why did that stock price move? And it really talks about some very wild price movements. We've had really wild price movements in the last 5 years. I mean, you've had Meta, which is the parent company of Facebook and Instagram, go from $70 to $600 to $300 to $600 again. I mean, just a wild ride with not, and the actual changes in the fundamentals alone couldn't explain that. So certainly the fundamentals had deteriorated when the stock got down to 70, but there's so much more going on with the macro environment, with behavioral, things like that. So anybody who's interested in that, I put in my email, kjacks@moneyinyour20s.com. I can send you a PDF of the chapter, but it really goes through what I had just explained about all the different reasons a stock price can move. Also, it applies to bonds, but bonds are a little bit more straightforward because you certainly don't have this voting mechanism of, meme stocks or people getting hyped up on different stocks and things like that. Bonds are a little bit more normal, predictable, mathematical. So feel free to email me if you would like your one free chapter. Okay, so what is the best use of the 80 minutes that we have left? We actually have 77 minutes left. Well, if we're going to talk about the macro environment, I'm sure you've noticed this, in the news, when the things that hit the headlines when they talk about inflation data, like the CPI data or the PPI data or the PCE data, or interest rates. Is Jerome Powell going to raise by 0.25% or 0.5%? What is the, and he represents kind of the Federal Reserve. What are they going to do? Where is the economy going? So I put in, we hold these truths to be self-evident because there's sort of this accepted view of what is critical to the economy and what do we have to look at, and what could go wrong, what could go right, how is the Federal Reserve in the middle of it? So this is sort of like these accepted truths. I mean, it's funny to me because economists sometimes act like their science is as precise as like physics, right? Or, something like gravity, like the rules of gravity, or water boils at a certain point, like that economists think that they have rules that are just as solid as like, real scientists. That's kind of insulting, but economists are kind of in a pseudoscience. So these truths that everybody holds, I mean, they hold them like they're water and gravity, but you're going to have to decide for yourself. But we should at least mention what we think these truths are. And since inflation is such a big part of it, we're really going to get into the top inflation indicators. And then we're going to delve into the book, the guide to the 50 economic indicators that really matter, because at the opening of that book, these truths are so self-evident to the authors that they're like, yeah, but see, everybody already knows that. So we're not even going to cover the indicators that everybody already knows. So we're going to delve into the ones that are a little bit more unique. So the best indicators in the book are not even the biggest indicators that you have to watch. So first, I'm going to cover the ones that you have to watch. Then I'm going to drill down into the book. And when I say the best indicators in the book, I mean, this is subjective, really. I'm trying to give you the ones that would be interesting to you, would be relevant, ones that are a little bit easier to understand. And I definitely steer clear of the obscure ones, or the ones that only impact like 5% of the economy. Fascinating book, but like, let's be real. Like, let's stick with the ones that most people would be interested in and can understand. Okay, so best use of the time we have left. We're going to look at the 50 best, or we're going to look at the best indicators, but we're also going to look at one of my favorite podcasts called The Indicator by NPR, just because I want to make sure everybody knows that it's out there. Because if you're really going to get into economics and the macro environment, I mean, it's kind of, this show is amazing. It's only like 10 minutes, a daily 10-minute dose of, the things that are being measured out there that you might care about. I want you to know about that. You can add it to your podcast list, and just like a quick review of also like the Wall Street Journal and Bloomberg and things like that. And then finally, since we're taking the time to really get into the macro, get into the economy, does macro dominate? I mean, is macro the most important thing? Is the direction of the economy, is the Federal Reserve action, is all that really the most important when it comes to your investments? Fair question. I'm going to say with bonds, yes. And I'm going to say with stocks, no. It's not that simple. Okay, so that's where we're going with this. And I'm going to quickly check the chat, just make sure there's no question. I see one, but I think that was... oh, please enter your questions in the chat box. Yeah, there you go. Okay. All right, so let's get started. All right, we hold these truths to be self-evident. This line at the bottom, the arrow in either direction, I'm just calling that the economy, right? So what can happen with our economy? Well, you can have Goldilocks, right? Not too hot, not too cold, just perfect, like just chugging along. We like that. Or you can have the too hot economy with runaway inflation, which we saw in 2022. Or you can have a too cold economy, heaven forbid, with a true recession where people are people are losing their jobs, earnings are starting to fall. There's just pain, right? There's slowdown. There's businesses aren't doing as well. So we like to hang out in the middle, right? We like the Goldilocks economy. We like the not too hot, not too cold. But I put the Federal Reserve in the middle here, and very tongue-in-cheek, I have a photo of Gandalf, the wizard, but with Jerome Powell's face. So Jerome Powell is the head of the Federal Reserve, and the Federal Reserve wields its magic to constantly monitor the economy. And then if the economy is overheating, they come in with their magic wand of interest rates and raise interest rates. Or if the economy is really struggling, at times when the economy is really struggling, they can dramatically lower interest rates, which they've done numerous times in the past. So the truths that we hold self-evident are a too hot economy is very bad. Inflation is incredibly painful for the regular person. A too weak economy is really bad. People are losing their jobs. So we need to have this balance. And there is this belief that the Federal Reserve has tremendous power to keep us in balance. And they do that. The part we're really going to focus on is the Fed and the Fed's effect on interest rates. I know they do other things, but I don't want to get too complicated tonight. It's just in a normal economy and the normal data that you see in the news, it's all about, will the Fed, cut rates? Will they continue on this path? 2 years ago, was it, will they raise rates? So we're just going to stick with the interest rates for now. But to a lot of people, it's really important to see that this is the backdrop, right? So if you buy into like, this is the backdrop, this is how it works, then you see why experts say, okay, this is the macro environment, and this is what you should understand if you're going to be an investor. So Marty Zweig wrote Winning on Wall Street back in 1986. People still talk about it. He's an extremely, extremely successful money manager. He's the one who came up with the tagline, "Don't fight the Fed." And he claims that, the major direction of the market is dominated by the macro, dominated by the actions of the Federal Reserve, specifically where they set interest rates. So this is the macro story. Okay, we're going to forget about fundamentals, forget about earnings, forget about like who is CEO of what company, forget about behavior, forget about mania, forget about recency bias or home country bias or all the other things that impact investments. If we just do macro, then experts like Marty Zweig will tell you that the most important thing is to look at what's going on with the Federal Reserve. And what the Federal Reserve is looking at is what's going on with the inflation data, okay? And the Federal Reserve is obsessed with keeping inflation in check. And then also, which is the problem that we have now. At other times, they're obsessed with, too much unemployment, the economy's too weak, and we need to boost the economy, and that's when they start lowering interest rates. But right now, we're looking at the Fed and whether or not, because they had raised interest rates, are they going to keep them sideways? Are they going to lower them? This is the whole point. And so what is this "Don't Fight the Fed" tagline for investors? And basically, and I got this from an online source called The Balance, that "Don't Fight the Fed" is this investing mantra, right? It suggests that you as an investor should align your choices with the actions taken by the Fed, right? So I'm not going to get into the Fed. There are 12 regions of the Fed, and there's a board of governors and blah, blah, blah. Obviously a lot of smart people in different pockets of the United States are impacting and get a vote on where interest rates are going. It's not just Jerome Powell. He's the face of the Fed. But basically, they're going to be setting these interest rates. And the mantra, "Don't fight the Fed," means you as an investor should pay attention to that, and you should align with the Fed, meaning you should invest aggressively when rates are low and conservatively when rates are high. All right. So here's just like one example of this in action. So this is a chart of the 10-year Treasury, right? So when the government borrows money, the government borrows money by issuing bonds. And so if we just look at what the government was paying on a 10-year note, right? So when the government says, okay, I'm selling this bond, I want, institutions and people and whatever to buy it. It's a 10-year note, so you're lending the government money for 10 years, and here's the interest that the government plans to pay on an annual basis, right? And so right after, during and after COVID, interest rates were dramatically low, right? Dramatically low, even under 1%, like on a 10-year note, which is incredible. Like you're borrowing money you're lending money for 10 years and you're not even getting paid 1% interest per year. That's kind of preposterous, but that's what was happening. Then you see that between 2022 and 2023, dramatic rise, right? So you go from interest rates that are like 1.5% to interest rates that are 4%. Like that's a huge rise. And I just pulled this data. So I mixed actually two. I mixed the chart, but then data from this news outlet called The Street, where they said that the Fed hiked interest rates 11 times starting in March of 2022. So that's why you see this really dramatic run up in rates on the 10-year note. And so even prior to the end of 2023, the 10-year note was paying 4% annual interest, which was, a dramatic difference from where we had started in 2022. Okay, well, knowing what we know now, right? The Federal Reserve tries to cool the economy because the economy was white hot by raising interest rates. And we're saying that when they do that, it's bad for investments. Did that actually happen? Well, let's look. In 2022, between 2022 and 2023, the S&P 500 declined 18%. Very dramatic. You might have a different number in mind because I'm taking the number that includes dividends. So, even though the price, the basket of all the stocks, that aggregate price was going down, stocks were still paying dividends. So some people say the S&P was down more than 20%. I choose 18% because I count the dividends. So you might see things, different. But anyway, bad news, right? It's not good. That is, you're an investor. You do not want to see your investments decline 18% in 1 year. That is very scary. Of course, you could look at it the other way, which if we look at, how low interest rates were, dramatically low, under 2%, and then we look at what investments were doing at that time, they were chugging along up, 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 which again is this like kind of don't fight the Fed. So when the Fed has very low interest rates, that's when you should be investing aggressively, which clearly people were. And then, okay, so hopefully everyone understands this. So here's the interest rate on the 10-year note. The interest rate was really, really low. The Fed was keeping interest rates low. And then you had woo, nice bump up in investments. So those were the good times. Then interest rates climb. The Fed hikes interest rates 11 times. So what that means is like, the Fed meets and the Fed votes, and then they come out and you see the news conference and they're like, okay, we're raising a 1/4 point. Okay, we're raising a 1/2 point. Okay, we're raising, 0.75. Those are all those news conferences that you're seeing. And so when you add up all of those over time, if it's 0.5, 0.25 here, 0.25 there, it takes a while to lift all of these rates. But over the course of the year, they had raised rates 11 times. That had this very dramatic negative effect. Okay, so right now, what we consider the truth, the macro truth, is definitely holding up, right? So we're finding that when interest rates are low, the economy overheats, inflation spikes, but also investments go up. When the economy is overheated and the Fed steps in to lower inflation by hiking rates, if the rates hikes are consistent and dramatic enough, you're going to have investments decline. So this is the big macro story. Okay. In fact, what the Federal Reserve does can be so dramatic that it can literally make presidents violent. Okay. I thought this was an amazing story. I love studying the biographies of the various presidents. And I remember at one point, and I love to listen, I do books on tape. So I was listening to President Johnson's biography, and they mentioned, he had a very strong personality, had a big temper. And they mentioned that he physically assaulted, I shouldn't laugh, that he physically assaulted the person who was the chair of the Fed at the time that Johnson was president. So this famous guy, William McChesney Martin, he was the chair of the Fed for years and years, and he had kind of bowed to Johnson initially, and really like did not raise rates and was very patient for a long time, and then finally was like, I just have to raise rates. Like all the data is there pointing to this economy overheating. And so President Johnson was very upset, had the Fed chair come down to Johnson's ranch in Texas. And there have been several credible reports that Johnson got so mad that he physically shoved the Fed chair all around his living room at his ranch in Texas. So, people really buy into this. I mean, the politicians, everybody really buys into this, that the Fed has the power to really like slam the brakes on the economy, which it needs to do because inflation is so bad for regular people. But, especially a president in an election year does not want to see people starting to lose their jobs. Even though ironically, people get very upset about inflation. So people aren't dumb. If you don't put the brakes on the economy and then inflation spikes, it's not like you're going to do that well as a politician anyway. But this is how serious it is, and how people understand this macro environment and how they really take seriously what the Fed is going to do. And I put a punch bowl on the slide just in case you've ever heard a separate time. William McChesney Martin was famous for giving a speech where he said that his job is to be like that guy at the party when just as the party is getting wonderful, he takes away the punch bowl, right? I'm assuming it's a punch bowl spiked, right? I don't think people care that much about an unspiked punch bowl, but that is a famous line among economists, people who study the macro environment, this like whole idea of taking away the punch bowl. So the Fed, in order to cool things down, will raise interest rates, which has the same sort of psychic effect on people as like taking away their libation. All right. Okay, so conclusion, inflation is key, and the Fed raises interest rates to lower inflation, and that's a negative for stocks and bonds. And we're going to get into, is that always true? And it's very true of bonds, not as true of stocks, but we'll get into that later. Okay, so since inflation is so critical, then we want to be educated about the top inflation indicators. And I'm going to try to make this not boring because it's a lot of, CPI, PPI, blah, blah, blah. All right. The one that is the one that's the easiest to understand, the one that is in the news the most, the one that's the most accessible is the Consumer Price Index, the CPI. And it measures all sorts of things. I mean, it's going to measure what you're paying on airline tickets, what you're paying for cereal, what you're paying for gas in your car, what you're paying for healthcare even. I mean, it measures so many things. And the CPI is the one, like that headline CPI data is the thing that like is probably quoted the most in the media, and it's probably the most familiar to you. For reasons that are kind of complicated, the Federal Reserve used to use the CPI, and now it says it goes more by the Personal Consumption Expenditures Index, the PCE. These studies are both like kind of managed by government agencies, released by government agencies. And so what's the big difference? Like, why would the Fed switch from one to the other or say that they're more interested in one than the other? You can listen to really interesting podcasts about this. In general, the scope of the Personal Consumption Expenditures Index, the PCE, is a broader scope. So that makes sense to me that the Fed would want the thing that has the broadest scope to have what should have the biggest impact on the economy. But it gets so much more confusing than that. And they really start getting into weighting, like how much is shelter a factor in the overall CPI score versus how much is energy consumption versus how much is food consumption. So this is this whole weighting thing. Like, what would be a good, like say, you go to, you're a student and you're looking at your GPA, and they say like, oh, well, if you're in an honors class, that has like a higher weighting than just like a regular class. I mean, there are different ways to measure things. And so like, say your GPA is now going to be higher because you got a good grade in a class that holds more weight. So numbers can be managed, massaged, all different things. So the people who really, really get into this and they debate this, it's like, well, should the weighting for shelter, should shelter have so much bearing on what our overall view of the inflation picture is? It's so different, right? So if someone owns their home and they locked in a 30-year mortgage, right? And they did it a bunch of years ago. I mean, if they did it like 5 years ago, they have a really good interest rate. They're just kind of sitting there, and dramatic price swings in rents are irrelevant to them. So how does inflation occur for the regular person? It really depends, right? So if I have my home and my 30-year mortgage locked in, my costs for repairing my home, painting my home, heating my home, that's changing. But the overall cost of what shelter is costing me, just the mortgage, payment, it stays the same. But then you have people going out and trying to, say they graduate from college and they're trying to rent in a new city, and they're blown away by the increase in prices, and they're incredibly impacted by inflation. So there's a lot of, it's tricky, right? It's just, how much weight should any one measure have? And it affects people differently. Now, all of us have to eat, right? So food, food's a pretty obvious one. But oddly, like sometimes for reasons of supposed like consistency, things like food and energy will be stripped out of data and it'll be looked at separately, which is so bizarre to me because food and energy impacts all of us. I mean, all of us have to, drive cars or have heat or eat lunch or whatever. So I'm like, why are you stripping out the things that are actually the most relevant to what is going on with inflation? But I'm not going to get into the nitty gritty. Just you should know that the consumer price index, to me, that's the big one, the one that's most familiar to you. The Fed goes more by the personal consumption expenditures index, whether they should or they shouldn't, hard to say. Then you have the producer price index. So the first two are based on consumers and the prices that they're facing. The final one, the PPI, the producer price index, those are like the wholesalers, right? So those are the people who produce goods. Like what costs are they looking at? Like what raw costs are they looking at? And how are those costs going up? So anyway, these are the big three. And this is how inflation, is gauged. I don't think it's true that the Fed does not ignore the other measures, but in terms of their own weighting, they say that the PCE is the most important to them. And the PCE tends to be lower than a lower number than the CPI. Okay, so very hard to read, but just in case you were wondering, why did the Federal Reserve hike interest rates 11 times starting in March of 2022? This is how bad the inflation data became. So, let's look at 2019, sort of these vertical bars, these vertical like dotted bars, like that's, 10%, then 20%, then 30%. And you can see that there's hardly any inflation, right? Like really like nothing to worry about. So on all these different items, whether you have food at home or you have food other, so what, I'm sorry, it says food at home, other food at home. Okay, let me not get into the nitty gritty. Let's do like the food, the cereals, the non-alcoholic beverages, all that food stuff, hardly any inflation, 2019. Then you go to the other side, and now we're looking at, what was happening in 2022. And so many of those bars have passed over the 10% range. They're like hugging 15%, 14, 15%. So you have all of these different items where you had almost no inflation, and now you have like triple the amount of inflation. And then on certain items like fuel oil, fuel oil just took off. It was like 40% inflation. And when I first researched this, I kept looking at what I was finding online because I thought I must be reading the wrong chart, or I must be reading this chart incorrectly, because how could we have that much inflation? Like how could like dairy products or cereals be up that amount? But this is truly what happened. And this is why the Fed became so alarmed and had to hike rates so quickly. Now, this is CPI, okay? So I just do CPI because it's so easy to read. But I understand, like, the Fed does PCE, they look at CPI, but they go more by PCE. But I just did this more for you to understand, like in all of these categories, there was this dramatic rise in inflation, whether it was fuel oil or electricity or oh my goodness, insuring your vehicle just through the roof, airline tickets, everything through the roof. And that's why you got the 11 rate hikes. Okay, so let me just go back to here. All right, so I just want to make sure you saw all of that crazy inflation data, and then you saw like the 11 rate hikes, right? So this is exactly what happens. This is how this economy issue works. And then you have the really bad for investing. So you got the hot inflation, you've got the Fed trying to cool the economy with the rate hikes, and then you've got the very nasty for investments. And really terrible for bonds. I should have actually had a bond chart here, because like the worst year for bonds on record. Okay. So those are the top inflation indicators, the CPI, the PCE, the PPI. Then we get into this book, The Guide to the 50 Economic Indicators, where the guys who wrote the book are like, oh, well, of course you already know about the big economic indicators, so we're just going to drill down into the other stuff. So why are we drilling down? Well, the idea would be, if we really hold these truths to be self-evident, that like inflation is bad, and that the Fed is going to raise rates, but then we're afraid of a recession. And if rates go too high, we know our investments are going to go down. And if there's a recession, heaven forbid, like then they could, our investments could really crater. Then we're going to be looking for clues, right? We're going to be saying, well, how could we know in advance if there's going to be inflation? And how could we know in advance if there's going to be a recession? And so what are those economic indicators? And that's what these guys who wrote, the 50 economic indicators that really matter, that's what they were trying to do, is like, you should be out there looking for clues, not just sitting around waiting for CPI data and waiting to find out don't be reactive. Don't just wait to see what the Fed does. See if you can kind of predict where this economy is going. Okay. So these are the ones that I thought would be the most relevant, certainly the ones that are most straightforward to explain. But it's a terrific book. Feel free to take it out of the library. They have plenty of copies. But I thought these would be really, really good ones to drill down into. So the employment one is, that's pretty easy. I'm sure you hear about it all the time. I think I probably got this from the Wall Street Journal, but once a month, it's like, well, how many jobs were added to the economy? Or, when things are really bad, it's like, how much of an uptick was there in unemployment? So in October, there was actually a really, really bad reading on jobs. It was kind of surprising. I was like, wow, like jobs were just missing. And then there was this big rebound in November. So that was kind of a relief. I mean, it's a relief and not a relief, because you want to make sure, like, you don't want so much of a rebound that the Fed will not continue to lower rates, because the lower rates are good for the investors. But at the same time, you also didn't want this incredibly negative jobs report in October, because that could signal, uh-oh, the Fed raised rates, but now maybe things have gotten too tight and maybe jobs are disappearing, and maybe that could be a hint of a recession. So, again, we're looking for Goldilocks, right? Like not too hot, not too cold. And the October reading was really, really low. But people are saying now that the October reading was because of the Boeing strike and also because of the hurricanes. And, people drill down into this data, people who really know a lot. And you can see like in September, the jobs were strong. So it's like, how could it go that quickly south? So it makes sense that it was like the hurricanes and the Boeing strike and things like that. And then, by November, we were back to something that was reasonable. Okay, so that's employment. So just so you know, it's just employment is always being tracked. So there are all these indicators out there. There are all these measures out there that once you become kind of savvy to all of these, certainly if you have like a Wall Street Journal subscription, I mean, the Wall Street Journal is like on top of it. Like the minute that data comes out online, like an hour later, they're going to have an article about it. So, whether it's employment or consumer sentiment or automotive sales, like the Wall Street Journal is always, always, always watching these things because they're very data driven and very sensitive to markets and things like that. So let's go on to consumer sentiment. So probably you've heard about consumer sentiment and how the Michigan university, it's produced at the University of Michigan. It's been going on for years, and it's a very sophisticated outbound telemarketing, talking to people about their feelings of optimism or pessimism, how they think the economy is going, what they expect to be doing in the future. And the guy, Marty Zweig, who I mentioned in the beginning, who came up with the whole "don't fight the Fed," I mean, he looks really, really deeply at monetary policy and the economy, but he cares a tremendous amount. He cared, excuse me, about consumer sentiment. So he's, again, someone who would be watching this data, very interested to see when all of this outbound telemarketing is reaching out to people, what are people saying about how they're feeling about the economy? And once you get used to this data, like you could see, if you were used to this data and it was December and you saw this reading of 69.7, you'd be like, that's kind of weak. You're used to seeing the data and that's kind of weak. Now it's up to 74. So you get used to seeing these numbers and you go, oh, that's interesting. It's getting better. Or that's a normally better number. So in any case, but why do we care? Well, consumer sentiment, how people are feeling, should then translate into their actions, right? So we care tremendously about the consumer. The consumer is such a big part of our economy. And if the consumer is feeling uneasy, if the consumer is feeling nervous, it's like maybe they're going to still get their Starbucks coffee, but they're not going to buy a refrigerator, right? They're not going to buy a car. They're not going to make these major purchases if they are concerned that the economy is going in the wrong direction, or heaven forbid, concerned about their own employment and things like that. So consumer sentiment, how people are feeling, is considered very important and really a tell on where things are going. Let me just check the chat real quick. Okay, remember, if you have a question, definitely put it in the chat. Okay, so let's go now. So we did employment and consumer sentiment, and everything I'm mentioning here, you could easily find in the Wall Street Journal. And the library, actually, if you go into the library, I don't know if you know this, because the Wall Street Journal can be a very expensive subscription. Although, just so you know, if you're paying for it and you call and you say, I want to cancel, they almost always offer you a better rate. I've done this for years now. But still, it's expensive. And if you go into the library, you have free access to the Wall Street Journal and any one of their computers, which is really cool. Okay, so then automotive sales. So I'm not going to show you a chart on each of these because that could get kind of boring, but you kind of get the idea, right? So if you're looking for hints, or you're just kind of curious, well, what do economists do? Like, how do other investors look for hints on where the economy is going? This is pretty much what they're doing, these big studies. So automotive sales comes out once a month, and it's just like it sounds. Like are people buying new cars, right? So what would be the normal level? And before the pandemic, it was something like 17 million new vehicles would be sold every year, right? And then in the pandemic, it dipped dramatically. Some of that I know was supply chain issues, obviously, and even like things like computer chips. I mean, go figure. Like, you want to buy this car, the last thing you're thinking about is how you can't buy a car because they don't have the computer chip for the car. But, you know, there were tremendous supply chain issues. So it's not just that, like, you know, car sales plummeted because people were unemployed or people were, you know, the consumer sentiment was terrible. It was also like they just couldn't be manufactured. So there was a huge mess. Well, that has all rebounded now. So the car sales are looking better and better. But at the same time, it's kind of bifurcated because you have some people doing very well in the economy, but the people who are lower income seem to be doing worse and worse. And the Wall Street Journal is writing about that, about how people are holding on to their used cars longer and longer, and that the average age of a car has gotten higher and higher because people can't really afford to like trade up or replace or do any of that stuff. So again, like looking at automotive sales is a real tell on how the economy is doing. Obviously, it's a big purchase. So again, Wall Street Journal, plenty of other places to get this information. Durable goods, it's just all more of the same story. So if I'm an economist or I'm just an investor who's interested in how the economy is doing, I'm looking at these big purchases. And durable goods, those are things like air conditioners, refrigerators, washing machines. I mean, these are big purchases that households make. And durable goods is also looking at big purchases that businesses make. Apparently, you know, you have trouble looking at the raw data, which is why you kind of need like the Wall Street Journal or somebody else to report on it, because the raw data will like include defense spending and like, you know, the Pentagon's buying aircraft. I mean, you like, okay, that's not the durable goods I'm looking for. Like what the government is spending money on is really not an indication of how the economy is doing necessarily. I want to get to the regular consumer or the typical business or things like that. So I wouldn't go hunting around for the raw data, but I would definitely be aware of like, you know, reading the Wall Street Journal and trying to find out what they are saying about the latest durable goods. And, you know, are people, you know, not buying nice things for their homes pretty much? Are businesses not buying upgrades? Those are very important questions. The price of copper, I threw this in because it's so easy to look at and it's kind of interesting. It's like, well, yeah, if there's going to be a lot of building and manufacturing in the future, which is a good sign of like a humming economy, you need the copper. You need the copper for all the wiring. So I just thought this was such an in this book, they talk about a lot of these indicators where you're like, well, yeah, that's kind of course, that's really interesting. Like yeah, you can't be building homes without all the copper, you know, wiring and some of the piping and things like that. So watching that price of copper is so easy. I mean, again, you know, there's so many like news outlets that track the different metals, whether it's gold or silver or copper or whatever. And you can just kind of look at the price of copper and you know, where's it been and where's it going? And that it's a pretty good gauge of, you know, sort of these big ticket items of like the things that are going to get manufactured in our economy. Okay, the last one, the Russell 2000. This I thought was so interesting. So there's the Russell 2000 and there's the Russell 3000. Now the Russell 3000 would basically be all the publicly, you know, the US publicly traded stocks, right? So if you know, the ones, you know, kind of like worth tracking. Well, then if you get rid of the top 1,000, not the bottom, the top. So you have your S&P 500 is obviously the largest companies in America, but then get rid of the next 500. So you're even getting rid of like those mid-tier companies. And so you have this sort of bottom 2,000 publicly traded companies. They're not all small caps, like that wouldn't be like fair to say that they're small caps, but you're looking at much, much smaller companies than, you know, the first 1,000 companies. And watching what the Russell 2000 is doing is a really interesting gauge because historically, when investors feel good enough to start going into those more fledgling companies, those smaller companies, that's usually a very good sign. When the smaller companies, with the stock in smaller companies starts to rise, that's usually a very bullish sign, a very optimistic sign about investing in general. And sure enough, this last year, especially since the election, oh my goodness, like these smaller stocks have really taken off. So to me, it's like it's kind of just as good a gauge of consumer sentiment or like, you know, people sentiment as the consumer sentiment survey. And it's so easy to track, right? So if you just go to Yahoo Finance or wherever you check your stocks, you could just, the Russell 2000 is just tracked and you can just see the chart of it and you can see, and it's been up, up, up. So at least for right now, things are very, very positive. Okay, and now I definitely want to mention the indicator by NPR. So these are just some screenshots. The show itself, it's usually less than 10 minutes. I think they aim for 10 minutes. And it's so well done. The people who create these shows, they are looking at economic data, important economic data, but they do it in such a lively and hilarious, very often hilarious way. And the voices on it play off of each other. And it is such an interesting and it's so illuminating. And it's free, right? So you just, wherever you get your podcasts, just put in the indicator. But this is like if you're going to be an econ geek, if you're going to get really into the macro world, this is the best way to do it, is just listen to these little 9-minute episodes. And they cover so much. They never fail. They never fail to cover consumer sentiment or automotive sales or any of these, these big items that I was talking about. CPI always, they would never miss a CPI print. So if you want to get into macro, this is the way to do it. And of course, you still have the Wall Street Journal. I really like the show Odd Lots by Bloomberg. That's another terrific podcast where they really get into the economy. And of course, there's the New York Times and things like that. But I had to put in my plug for the indicator because the people who produce it are so clever and they just make all of this data relevant and lively, and I just love it. Okay, so we've gone to the trouble of learning all of this stuff, but does it really matter? Does it really matter? And that's curious because we talked about how, well, the fundamentals matter and behavior matters. And some people think technicals matter. That's a whole other. And then then there's this whole other category of like, if there's legislation that could harm stocks, or if there's tax loss harvesting, which is just a mechanism that people might use. So investments prices move for all different reasons. So how seriously are we going to take the macro reasons? Like how much does it matter to investments if inflation is rampant and then the Fed restricts by raising interest rates? Like, how much does that really matter? Well, the truth is, with bonds, it's like a straightforward, direct, serious relationship. I mean, it really matters. If you are going to be, heavily in bonds, then you care an enormous amount about interest rates. And then with stocks, it's not that simple. It's really not that simple. So, but let's just get into bonds. You must understand how bonds are impacted by interest rates. This is critical if you're an investor. So I think it's very easy to explain. So I'm just going to, Starbucks actually does issue bonds, right? So I'm just going to use Starbucks as an example. I have not looked up recently what bonds they're issuing. I mean, I know that they issue bonds. I haven't looked at what they're doing recently, but let's just pretend, Starbucks is issuing a bond. So this is how people made money for years and years and years, because we had like a bull market in bonds for years. So you can imagine that, there's a Starbucks bond, like, you have a Starbucks bond where, you lent Starbucks the $1,000 and they're paying you 5% annually. So that's your coupon, is your 5%. Well, then interest rates are, this is before 2022, right? So you can just imagine, like, you're sitting on some bond, it pays 5%, but then interest rates keep coming down, okay? So then the new bonds don't have a coupon of 5%. They have a coupon of 3%. So the coupon is just the interest rate that's being paid on the bond. So you can imagine this. You're sitting on a bond that pays 5%, but the newbies out there, the new people looking to buy bonds, they don't have access to the 5% because that's not what's being issued. So the new bonds that are coming out are only paying 3%, right? 3% each year for 5 years on $1,000. Now, I know there is compounding in bonds. I'm not going to get into compounding, but let's just say, at 3%, you're making your $30, right? And over the life of 5 years, that's going to be worth $150. Well, that's not nearly as good as 5%, right? Because 5% would be $250. So there's this difference. Well, how does that, in a secondary market where bonds are being bought and sold, how do you accommodate for that? Like, what does that mean? Well, it means that the person who's going to buy a bond from you, if you want to sell your bond before it matures, they will actually pay you more for the bond. So the actual price of the bond is going to go up to compensate for the fact that that bond pays a higher coupon. So this is what everyone needs to understand, that if interest rates are going down, the current bonds are worth more, right? The bonds that are already in place that have the higher coupons, they are worth more. So the price of that bond will rise because the bonds that are being issued right now can't compete, right? So there has to be something in this secondary market where bonds are being traded that the older bonds with the higher interest rate will then have a higher price, because that's the only way to make up for the fact that if you buy them, you get the higher interest rate. So this went on for years, right? So we had a multi-decade trend of falling interest rates, because if you go all the way back to the 70s, where you had outrageously high inflation, crazy high inflation, you had like 14% inflation, then the inflation rate has been coming down, down, down. Interest rates have been coming down, down, down. And then the people who had bonds, they were sitting pretty because their bonds were considered more valuable because the newer bonds had a lower interest rate. So falling interest rates, great for bonds. Well, this whole trend, this multi-decade trend, obviously reversed dramatically in 2022, dramatically, which means that's very bad for bonds, very bad. So this is how you lose money in bonds, right? So imagine you're sitting around, you have bonds that are only paying 3%. And you have a bunch of them. You have a big portfolio of bonds that pay only 3%. Well, now all the newer bonds pay 5%. And you want to sell the bonds that you're sitting on. Now, if you just hold things to maturity, if you just hold a bond to maturity, you just get your coupon and you're fine, unless the bond defaults. But say there's a secondary market and you want to sell the bonds that you have. Well, you're going to have to offer them at a lower price because the newer bonds pay higher interest. So this is what they mean, like that bond prices fall, right? So as interest rates rise, bond prices fall, meaning like the bond that you're sitting on that pays the lower interest rate, someone's going to pay you less for that bond because of the paltry interest rate, because they can get a higher interest rate with the current bonds. So this is how people lose money in bonds. This is why rising interest rates is bad for current bondholders. It's not bad if you want to start buying bonds. If you've never owned a bond, it's actually fantastic to have like rising interest rates, because you can start buying bonds that actually have good yields. But this is this inverse relationship, right? So there's a very straightforward relationship between interest rates and bond prices. It's an inverse relationship. So the person who's sitting on a big bond portfolio does not want to see interest rates rise necessarily. Obviously, rates rise, they fall. Like if it's a trend of just up, 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 up with interest rates over years, that would be catastrophic, right, for bondholders. But if it's like a sharp increase, like we realized in 2022 because of this sudden inflation wave, and then that's going to be mitigated. And so the person holding on to these bonds, it's like they lost money on paper, but they didn't cash it in, and they're still getting their coupon. And then bond prices are going to get, they're going to get righted again. I mean, you just have paper losses in the short term. But in the long term, if rates, are high and continue higher, that's when it's really catastrophic. So right now, bondholders don't really know exactly what to think, because 2022 was a catastrophe. And then, things have been going sideways. But, well, if you think things are going to get better, then you're like, well, okay, so maybe we'll look back and be like, that was a very painful 2022 on paper, but it didn't really impact me because I didn't have to sell. And so then if interest rates start to fall again, or get back to something like more like a 3%, then maybe that's not so painful. But in any case, there's a very, very straightforward relationship between bond prices and interest rates. Stocks, not that simple, right? It's not that simple. So let's take like one of my favorite experts, Peter Lynch. He wrote One Up on Wall Street, one of my favorite books, and he is very solidly in the earnings camp. It's like, sure, there can be all these macro factors, right? And if you're only going to buy a basket of stocks, if you're only going to buy an index, right? If you're only going to do like, you're only going to buy the QQQ, or you're only going to buy the Dow, or you're only going to buy the S&P 500, you're putting all these stocks together in a basket. Then the macro is like important. But if you're buying individual stocks, a lot of experts would argue that ultimately it's the earnings that determine where that stock price is going. So the fundamentals will speak for themselves. So the company itself, the product they're producing, the profit they're making, the growth on their sales, the leadership they have, whether or not they pay a dividend, all these things that are fundamental to the company are going to be much more important than what's going on in the macro environment. So with stocks, it's just very, you really can't say, even though Marty Zweig, winning on Wall Street, was saying like, oh, it's all about the monetary policy, it's all about the macro. Well, you don't want to fight, I guess you don't want to fight the Fed if you just have kind of like a typical, mediocre portfolio. But if you're really, really clever about stock picking, then at least Peter Lynch would argue that your fundamentals will trump whatever's going on with the macro. And I think that's, important to know. And you definitely see, I mean, when you look at like winners and losers of individual stocks, they are all over the place. They're just a wild, wild differential of like how stocks perform. Nobel Prize winners also have a point, because they don't buy the macro story. And the macro story absolutely works with bonds. It doesn't necessarily work so well with stocks, because these Nobel Prize winners, Robert Shiller at Yale, and so Richard Thaler is the one who wrote the book Misbehaving. Richard Thaler is considered the father of behavioral economics. And he's the one who's like, all this stuff, all that you can throw data and science and numbers all you want, but people are irrational, they are emotional, and there's so much evidence in stock prices, in all kinds of prices, that people just do not behave rationally. And you cannot bank on, you cannot predict what stocks are going to do just based on raw data and logic. And I've definitely seen that over and over again in my own experience with stocks, that you have all these biases, right? You certainly have like a home country bias, right? So we're not rational in terms of like, nobody's rational, really. Like the people in New Zealand buy New Zealand stocks, and the people in Australia buy Australian stocks, and the people in Britain buy British stocks, things like that. We're in this country, we're buying these stocks. And we also have a recency bias, right? So if stocks have been going up, we tend to think that they're going to continue to go up. We actually fail to look at macro data. So macro data should impact stock prices, but sometimes we just fail to look at it because we have this recency bias of like things have been going well. So I'm finding this now, quite frankly, because I think there's a lot of data that shows that stocks should not be nearly as high as they are if you're just looking at the macro. And yet we have this recency bias because stocks have been doing so well. So I feel like people are failing to take their money out of the system just because of the recency bias. We also have an action bias. So we just tend to like make movements that we shouldn't make. So the data might say like everything's fine, but we have we can't help but like tinker and do things that we shouldn't do. All sorts of kind of biases that, and even like a loss aversion, right? So we hate losses. So when you have macro data that might say, look, things are not good, like you might want to get out of the market. If you're sitting on a loss, you probably won't take that action because you're like, I just can't. The losses are twice as painful as gains. And if I just ignore it, if I just don't sell, then I'll be better off. So there are all these different biases that kind of come into play, which make the macro world less of a direct relationship with stocks. Bonds, absolutely direct. Stocks, not so much. So just like, this whole human behavior side, I always like to mention Benjamin Graham, who's the father of value investing. I mean, he literally considered the market to be similar to like a manic depressive person who's like, this person is too high when they're high and they're too low when they're low. And, all the logic in the world, all the data in the world really hasn't like stopped that from being true in the market. So the macro stuff is very important to know, but take it with a grain of salt. I threw this slide in here just because I love Seth Klarman. Margin of safety, if you didn't know, there aren't that many copies available in the world. The library has a copy. The book itself is worth like over $2,000. Seth Klarman is a genius. He's very reclusive, very shy with the media. I'm sure he's not reclusive with his family, but he does not hang out with the media or regular investors. A brilliant guy, has done amazingly well with his own investment company. And he kind of looks at like, the technical analysis is not worth it. Wall Street pundits and everything they say about forecasts, like not worth it. But he really thinks that the fundamentals and macro is important, but really much more the fundamentals and much more just like the inherent value when you start, right? So if you're looking at a particular investment, if it's fairly valued or cheap, that is much more important than anything else, right? So he'd be very against this market right now. He'd be very against starting with these incredibly high, PE ratios and things like that. So I just love him, so I threw him in there. And then I also threw in John Spooner just because I think it's hilarious that he agrees that all of this stuff, this macro stuff really, really, really matters, but that no one knows the direction of interest rates. At the end of the day, like you can believe that macro really matters, but you're never going to figure out the direction of interest rates. You just can't predict even with all the data. So that kind of gets back to the whole, like, just do passive investing, just do index investing. You can't time the market. So take it with a grain of salt that, even if you listen to all this macro stuff, is it even going to help you? And then I always throw this in for all you wonderful people who are still listening. The S&P 500 right now, so like say like we do have these macro events, we do have the inflation and things like that, and you think, oh, okay, well, my main investment is the S&P 500 because this is most people's like biggest investment. And you think, oh, it's all evenly distributed over all these wonderful companies like Target and McDonald's and the Hartford and Johnson & Johnson and Walmart and Netflix and all, like you have all these great companies. And so then you're like, okay, I kind of understand, like if there's inflation, then the S&P 500 might go down like it did before. Okay, I get that. But here's the problem. The S&P 500 is so cap weighted that this is what you're really getting with the S&P 500, right? So you've heard about this, the Magnificent Seven. So you're really getting a ton of Apple, a ton of Alphabet, Meta and Nvidia and Microsoft. And I put in Berkshire Hathaway there because they own a bunch of this other stuff. I might have to take that out, actually. I think that by now they've dumped enough of their Apple that might not be true. But this idea that you're getting this like nice even distribution of all these companies is not true. So then the impact of macro data is kind of screwed up because inflation data, like if the economy is overheating, that is a negative, more of a negative for typical companies, like, or it's just kind of hard to explain because you're then trying to figure out, well, like, how does that kind of data impact these Magnificent Seven that are so unusual and so different from like a Target or a FedEx? Oh, did somebody have a question there? In any case, it's very hard to see what the macro data is going to do in such an unusual configuration where the S&P 500 is not a normal distribution of companies anymore. So it much more depends on how will that macro data impact a company like Apple. Does it mean that people are not going to buy the latest iPhone? Are jobs going to decline or the price is going to be too high? So just this whole skew of the Magnificent Seven, I think just adds a layer of complexity that everybody should try to understand. Okay, well, that's it for me. That's your macro, it's the economy, stupid. I know it was hard. I know it was very dense, very data dense. If you have any questions, you can put them in the chat. You can always email me later. I do want to go back to showing you for anybody who might want the free chapter of why did that stock price move? So if you're really into this, like, was it the behavior? Was it the macro? Was it the fundamentals? Blah, blah, blah. Feel free to email me, kjacks@moneyinyour20s.com, and I will send you that free chapter. And I'm going to do a quick check of the chat. Thank you for an interesting lecture. Oh, you're very welcome.
Thank you.
I know it was a very tough one. But hopefully you're smarter now than you were an hour ago. All right, any other questions?
I opened the registration for January already, so anyone welcome to register.
Oh, great. Oh, okay, right. So the January one is all about college and the $400,000 diploma. That's really scary. I'm going to take a picture of these nice comments. That's always nice to see. Next time I'm slogging it out in the library, I'll look at my phone and be like, this is worth it. People enjoy this stuff.
Definitely.
And I certainly enjoy doing it. So, all right. Well, I think that's it then. Everybody
Thank you.
enjoy their night. Don't think about macro, just go take a nice walk.
It's going to rain pretty soon.
I still have to walk my dog anyway. So dog walkers don't get a break.
Okay, thank you. Thank you, Kristen, and thank you everyone
Thanks.
for coming.
Thanks, Young.
Hope to see everyone again in January.
Hope so. See you then.
Okay, bye-bye.